Welcome to the Deep Dive. We've gone through a pretty complex financial report for you. It's dated January 8th, 2026, and our mission today is really to give you the ultimate shortcut.
Exactly. We're not just reading a report. We're synthesizing the critical friction points.
Yeah, the unexpected asset flows, and really the actionable strategies you need for this current market.
And our sources point to a central tension right now. That's really where we have to begin.
Okay, let's unpack this then. Starting with the fundamental color of the market, which seems to be a sticky, high-rate anchor just colliding with a seasonal liquidity shock.
That tension is everything. I mean, it is the backdrop that's defining every single capital allocation decision being made right now.
So let's start with the rates.
Okay, so if we look at the core interest rate structure, the U.S. 10-year Treasury yield, it's just refusing to fall. It's hovering stubbornly, around the 4.17%, 4.19% range.
And that specific range isn't just a number, is it? You called it a gravity anchor. Explain that effect for us.
Certainly. So when the risk-free rate, which is, essentially what the 10-year represents, when it's that high, it forces investors to re-underwrite every single growth stock thesis.
Oh, okay.
It heavily, and I mean heavily, favors companies that have near-term cash flow profits today.
Right, over those 5-year speculative promises.
Exactly. If you can get, say, 4.2% safely from the government, why would you risk your money on something that might not pay off for half a decade? Unless the returns are just truly massive.
And that's the valuation pressure we're feeling.
That's it. That's the pressure.
So if the high rate is the sticky anchor, then this seasonal liquidity data, that's the short-term shock we need to be watching.
Yes.
The report mentioned that the market tends to dismiss these things as, technical scheduling, but we saw that huge number, that $74.6 billion signal from the New York Fed. Why should you, the listener, worry about that?
That's the absolutely critical question, because that $74.6 billion, that was the usage at the New York Fed's December 31st standing repo facility, the SRF. The SRF, it provides cash to the banking system. But crucially, at the same time, we saw high usage of the overnight reverse repo, or the on and RRP.
Wait, okay, hold on. If the SRF provides cash and the on RRP drains cash, why are we seeing high usage of both at the same time? Isn't that contradictory?
It seems like it, right? But what it really creates is a warning signal, a signal of market choppiness.
How so?
Well, high SRF usage means banks are coming to the Fed for cash. They need it for end-of-year regulatory needs, that sort of thing. High on RRP usage means money market funds are simultaneously parking massive amounts of cash at the Fed.
So they're seeing the system as maybe a bit risky.
Exactly. Or they just have no better short-term alternative. So the combination banks scrambling for cash while others are sitting on it. It just signals short-term capital stress.
Even if it's seasonal.
Even if it's technical, it means the system is tight.
Yeah.
And any unexpected news could create a really disproportionate reaction.
So tight technical backdrop, and we still have this inflation problem that just refuses to completely roll over.
Exactly. I mean, core inflation is falling from its peak, sure, but it remains stubbornly sticky.
Which means we're all just watching the incoming data.
We have to. Any unexpected strength, especially in employment, it just immediately delays the market's hope for the Fed's first rate cut.
Right. And the labor market is still resilient. Good for the economy, but a headache for the inflation fight.
A huge headache. And the split environment, tight liquidity, sticky rates, resilient labor, it's causing capital flows to bifurcate, to split.
Okay, where is it going?
We see money dividing so clearly between two camps. On one side, you have these high-conviction AI and technology growth bets.
Right, promising that transformative efficiency.
And on the other, traditional safe haven assets. Think precious metals for protection.
That perfectly sets up our asset check-in. Let's see where that bifurcated money is actually moving. We'll use the January 7th closing samples at our snapshot. Let's start with the defensive core.
Yeah, the broad market ETFs, they're basically the bunker right now. They're the core defensive positions.
So VOO and QQQM.
That's right. VOO is the Vanguard S&P 500 ETF. It closed around, $636 to $637. And QQQM, the lighter weight NASDAQ Q100, was around $256, $257.
And they're holding strong because they're so heavily weighted towards that one sector everyone believes in.
AI and semiconductors, everyone believes that sector can grow right through this rate pressure.
And here's where it gets really interesting for me. Just the sheer dominance of that AI infrastructure play. What does the latest price action tell us about the market's conviction?
The market's conviction is it's unwavering. The focus is just fiercely concentrated on those AI infrastructure suppliers.
And NVA is the big one.
NVDA is the barometer for this entire thesis. It's the key financial focus, closing recently at about $188.
And that's not just momentum.
No. This price reflects the core belief that these companies are essential, that their growth is just so steep it justifies the high valuation, even with that 4.17% anchor.
And the other big tech peers.
Also holding their ground.
Yeah.
Meta was strong in the $648 to $656 range, and Neogy was active between $314 and $322.
So the message is clear.
Very clear. If you're paying a high price for growth, it better be growth powered by AI.
Okay, let's move over to the high-risk side, crypto. It's certainly defying all this interest rate pressure, isn't it? It seems to be ignoring the tight money narrative completely.
Bitcoin is the clear leader there. It's continuing its ascent despite this broader liquidity tension. It wrapped the day firmly in the $93,700 to $94,000 band.
But why is it defying that rate anchor? It's not macroeconomic.
No, it's structural and psychological. We're watching these crucial short-term resistance levels, 95K up to 98K. The signal isn't from the Fed.
It's from the ETFs.
It's from massive inflows into those new ETFs and all the activity in the options market. That's the short-term driver.
And Ethereum.
Ethereum, while not getting the same headlines, is tracking right in sync, sampled around $3,200 to $3,300.
We should probably touch on the highest risk corner of the market too, the pre-stocks.
Yeah.
Companies like OpenAI trading on secondary markets. What's the note of caution there?
Oh, the note of caution is loud. These are pre-stocks, private companies trading on these dispersed secondary exchanges.
Giving people a bet on future IPOs.
Exactly. For example, quotes for OpenAI were sampled around $1,030 plus or minus. But the key risk, the thing you have to understand, is the liquidity.
Right. It's not like a public stock.
Not at all. You're dealing with dispersed quotes, low volume. If you need to sell quickly, you might not find a buyer, not at anywhere near the last price.
So this is for small, speculative bets only.
Small, highly speculative exposure where you are comfortable losing the entire amount. Absolutely.
Discipline is paramount.
Yeah.
Especially when we see volatility driven by things completely outside of tech and interest rates. Let's connect those geopolitical drivers.
Well, the primary volatility driver in the last 24 hours was a complete wild card, a geopolitical one.
Related to commodities.
Yes. Developments regarding the U.S. and Venezuela. Specifically comments about oil transport and sanctions. It caused WTI crude oil futures to slide significantly.
What were the numbers?
Reports cited a price around $56 or 35 cents, and that news just came completely out of left field.
Proving you can be right on the technicals and still get steamrolled by a macro headline?
Instantly.
I see the immediate connection there, though. Risk slides, safe havens lift. That capital rotation was instant.
Textbook. It was a textbook surge in safety buying. Gold sampled between $4,450 and $4,485, and silver around $78 to $80. They both showed a strong initial lift. But we saw quick profit taking. It pulled them back slightly, which suggests that while investors sought safety, they're also nervous. They're quick to take money off the table.
A classic sign of a market that lacks conviction outside of that AI story.
Precisely.
Okay, before we get to the final strategy, let's talk about the data marathon this week. Which reports are likely to knock that 4.17% anchor loose?
This is critical because this data will dictate the repricing of the entire Fed path. We have a barrage of it. JOLTS, ADP, ISM.
And the big one.
And of course, the highly anticipated non-farm payrolls. If any of these show significant resilience, particularly non-farm, the market will delay that rate cut expectation.
Pushing the 10-year yield even higher.
Potentially. And this data will directly influence currencies, including the DXY, the US dollar index. It's oscillating now around 98.5 to 98.7. A strong non-farm report could send it much higher.
Adding even more pressure.
Yes, on commodity prices especially.
So we've established the anchor high rates, the shock liquidity tension, the growth refuge AI, and the volatility triggers Venezuela and non-farm.
What does this all mean for the listener's portfolio? How do we synthesize a strategy for this?
The synthesized strategy, it really emphasizes defense and discipline, above all else.
Okay.
Given that dual pressure, you must maintain a defense-first posture. So you keep those broad-based ETFs, your VOO and QQQM, as your core foundational positions. They are your financial bunker.
And for those high-conviction growth plays, the AI leaders.
For NVIDIA, GOG, Meta, we'd recommend shifting to a buy-the-dips approach. Don't chase new highs. Set staged entry points.
Right. And Crucially, you should supplement this with option protection, like buying protective puts, or more simply, just making sure you have significant cash buffers.
Keeping some dry powder on the sidelines.
Always be ready to deploy if the market sells off because of tight liquidity or that non-farm data.
And finally, that high volatility segment.
Yeah.
Crypto and the pre-stocks.
For crypto and pre-stocks, it has to be strict adherence to small, staged entry points, and you must use clear, non-negotiable stop-loss rules.
Define your maximum loss before you even click buy.
You have to. The combination of extreme volatility and that liquidity sensitivity makes discipline just absolutely essential for preserving your capital.
Okay, so a final summary.
To summarize it concisely for you, the market is defined by two competing pressures: that mid to high interest rate anchor and the seasonal liquidity event, which we're tracking via that $74.6 billion SRF usage.
Right.
Geopolitical news on Venezuela and oil is magnifying short-term risk, but the structural money flow remains focused on AI growth and defensive metals.
So the sources confirm the short-term path hinges almost entirely on two non-asset factors: the technical liquidity metrics we just discussed and the employment reality from the incoming non-farm payroll data.
That's what it boils down to.
So our final thought for you to consider based on this deep dive: which of these two variables, the technical liquidity tightness or the unexpected resilience of employment reality, which one will have the most surprising and disruptive impact on the Fed's next decision? Thanks for joining this critical deep dive.